What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over SPY, which is the S&P 500 ETF, and we're also going to cover some other notable names on the market, names such as Tesla, Apple, AMD, Nvidia, Meta, and Amazon. Before we get started on our charts and talk about levels and price targets, we have to talk about some things that happened last week and some things that are going to happen this week that may potentially help markets reverse back into a bullish trend, or they may force them to come down even lower. This is a very busy week that's filled with earnings and multiple key reports, so it's going to be extremely important for you to take caution as you are trading and as you are analyzing your charts. First things first, the first thing we want to cover is going to be this week's PCE report, which is expected on Friday. The PCE report is another inflation report, but this specific inflation report is the preferred inflation gauge that the Federal Reserve uses. Remember that the Federal Reserve is the reason that the entire market started selling off back when it started selling off on April 4th. This was the same day that one of the federal members stated that they can potentially see no interest rate cuts this year because of lingering inflation, and ever since that day, the market has been coming down. Other factors have been fueling the downside movement, such as the geopolitical tensions in the Middle East, but nonetheless, the reason that the market is selling off, or the primary reason it's selling off, is because those interest rates are looking like they're going to stay high for a longer period of time than expected. Since the start of the market rally, when it started back in October, that was around the same time that the Federal Reserve first introduced the idea of rate cuts in the coming year. However, ever since the start of that rally, we haven't seen any interest rate cuts, and now that those hopes are starting to fizzle, we can see that the market rally is going down along with it. Last week, we also saw in earnings from companies like Netflix and TSM, Taiwan Semiconductor. Netflix is one of the first Magnificent Seven companies to report earnings, and yes, although they beat expectations, unfortunately the company's guidance fell shorter than expected, and you can see that the market sold off, and so did the stock following their earnings. Same exact scenario with Taiwan Semiconductor. This is another stock that was doing so well for most of the year, but unfortunately its earnings are just not keeping up with the fact that the stock is trading at such a high. Now Taiwan Semiconductor in specific is a very important stock to watch because it is one of the first companies within the semiconductor sector to actually report. And so when they did report last time, so in the previous quarter, this jump that you see here on the chart actually forced all semiconductors to jump up with it. Now the exact opposite thing happened this time around. You can see that the stock actually gapped down on earnings, and other semiconductor stocks like Nvidia came down with it. Nvidia posted a 10% loss, its worst day in months, and you can see that it broke below the 50-day moving average, just like we saw SPY did this week. Now, speaking of SPY, let's go ahead and talk about SPY on the daily candle and then move on to the shorter term time frame. We always like to start off with the daily time frame because it gives us an idea of what's happening on the macro picture. And obviously we can see on the macro picture that SPY broke below its 10, 20, and 50-day moving averages, all of which are key supports that we have been holding ever since the start of this rally. In fact, we have not broken below the 50-day moving average up until we broke below it on April 15th, the first time we moved below it ever since the start of that rally. Now that we're below that line, you can see that we quickly moved over to the next support point, which is going to be the 100-day moving average. So coming into this week, the first and last thing you should do on the daily time frame is check to see where that daily candle opened and closed in relation to that 100-day moving average. As long as SPY is staying above that level, then buyers have a fighting chance of reversing us back up. But if we move below that level, then we can potentially see more lows. Now, speaking of those lows, here are some levels for guidance. To the top side, you have a resistance at 500.50. Buyers are going to need to get above that level on SPY in order for them to gain any kind of confidence. Above that level, they can potentially see 506.50, and above that, they can move towards 515.30. But remember that there's a lot of skepticism in the market right now. There's a lot of uncertainty, and it's going to take some kind of positive catalyst for us to move up. Now, that positive catalyst can come from that PCE report that we talked about earlier, and that's expected on Friday. So between Monday and Thursday, you have to keep in mind that Friday's PCE report can potentially change the trend of the entire market because inflation remains to be the biggest fight that the Federal Reserve and the market are fighting. Now, one foreshadow that we got a couple weeks ago that may tell us what we can expect on the PCE report is the CPI report, which is the PCE report's distant cousin. It also measures inflation, but it measures it on a different scale. And you can see that the CPI report actually moved up month over month from 3.2 to 3.5%, which is another reason that the Federal Reserve restated the fact that they may not be lowering interest rates this year after all. The jump in inflation is obviously not good for the US economy, and as tensions rise, and specifically the Middle East, we know that oil and energy starts to go up when anything happens in the Middle East, and that also drives inflation up with it. So with that being said, we may see an uptick on that PCE report this week, and if we do see that uptick, consensus is 2.6%. If we come up to 2.6 or higher, then we'll likely see a negative reaction from the stock market. Now, apart from the PCE report, we also have the GDP report coming out this week. We're going to finally get Q1's estimates, and we want to see growth. If we see negative growth, that means we may enter a recession period, but as long as we're posting positive growth, then the GDP estimates are actually looked at in a positive way. Now, one thing to keep in mind, and this is why we actually expect GDP to come in a growing phase on Q1 specifically, is because of all the exports that the United States is currently exporting. Remember, guys, we are funding wars across the world between Ukraine and Israel, and we are exporting a ton of material, we're exporting a ton of weapons, and all that actually helps the country's GDP. So just keep that in mind if you are wondering what to expect for GDP this week. Alrighty, so now we've covered SPY, we've talked about the economic reports. Let's move on and talk about some stocks on our watch list. First and foremost, we have Tesla on our watch list, which entered a fresh new 52-week low last week. Tesla is expected to report earnings this week, but people are not very optimistic, as you can pretty much tell from the chart. Now, what happened to Tesla last week that drove it so much lower? Apart from the fact that the stock has been suffering and slowly declining in sales, Tesla actually recalled all of its Cybertrucks because of an accelerator pedal problem, and you can see that obviously hurt the stock significantly on Friday. There doesn't seem to be any buying power on the stock, and we would be very surprised if this week's earnings actually did anything to help the stock out. You can see that analysts already expect very low expectations from the stock for the first quarter, about half what it did last quarter. And so even if Tesla is able to beat those expectations, it's likely not going to be enough. Tesla is going to need to come up above all the 4 quarters that it had in the past in order for buyers to get any kind of confidence. It's likely not going to be enough that it just meets these estimates. If you are looking at Tesla and you're wondering how to trade it on the shorter term time frame, here are some levels to focus on. First things first, Tesla is currently in no man's land, which means there's not much support to the downside. If it breaks below last week's lows of around 145.30, then we can expect the stock to continue free falling to the mid 130s. To the top side, Tesla is going to regain the 158.35 resistance in order for buyers to regain any kind of confidence. But nonetheless, the stock is generally in a bearish trend, so you should be looking at more downside than upside. Now, looking at Tesla on the financial side of things, just a quick cap on this, we see that Tesla's price to earnings ratio is coming down to around 34. So this is starting to get attractive, although we don't think the stock has enough power to reverse yet. It is starting to come down to a point where it could be a potential buy. We'll update this stock and we'll update the attraction of buying as we continue updating you guys on videos. But just real quick, Tesla is starting to move into a more attractive position in which we can potentially see buyers step in, and that could happen right around the mid 130s. Now, the next stock on our watch list is going to be Apple. Like Tesla, Apple is actually heading towards its 52-week lows. You can see that it actually bounced just above those 52-week lows that happened right around 162 last week, and we expect the stock to continue moving its way down. You can see that the stock spent about 3 to 4 weeks consolidating here within this range, and it finally broke above it last week, which means that the stock could be in trouble. Here are some levels to focus on for Apple if you are looking at the shorter term time frame. Apple, obviously, as stated, it's already trading within a bearish trend right now. As long as it is below 168, we're extremely bearish on the stock, and that is just on the technicals. The company's financials are still solid, but just the short-term technicals are not looking very promising, and that could be because of slowing iPhone sales and just the company not coming out with any groundbreaking technology so far, or at least lately. To the downside, if Apple breaks last week's lows of 164.08, our downside price target is going to be right around 159. Apple is not going to regain any kind of confidence from buyers until it's back above 178.70, which is where you can see it had this double top rejection. If it regains that level, then we would start looking at more bullish plays in the short term. The next stock on our watch list is going to be AMD. AMD suffered significantly last week, and we don't blame buyers for letting go of their positions. For a very long time now, people have questioned the strength of the semiconductor sector. Many people were wondering if the artificial intelligence bubble is only growing. AMD is one of the leading companies after Nvidia in terms of stock gain that benefited from the AI boom. However, you can see that AMD is still trading at a price to earnings ratio of around 296, which is an extremely inflated number. That means AMD will have to boost their earnings significantly in order for them to adjust this down, or the stock needs to correct even lower. Now, with that being said, you're maybe wondering, what is a healthy price to earnings ratio? And a healthy price to earnings ratio is usually between 15 to 25. Now, sometimes some companies will trade above that price to earnings ratio if their earnings and their profits are expected to grow significantly. However, 296 may be a bit too much for AMD, which explains why the stock was suffering so much last week. A lot of people were starting to realize that this company may be a little inflated, especially after TSM, or Taiwan Semiconductor, reported weaker than expected guidance in terms of chip sales, which is along the same industry that AMD is in. So if you are looking at AMD on the daily chart, you can see that AMD broke below all of its healthy moving averages, including the 100-day moving average. The only moving average left for it is going to be the 200-day moving average, and these moving averages are what institutional traders watch in order for them to find reversals or place to buy. And you can see that they obviously have not been interested at any of the significant moving averages, and the next significant moving average is that 200-day. So with that being said, did buying appear at all to end last week? No, we actually saw more selling, and selling volume intensified to end last week, which makes us believe that there is more downside from AMD in the coming weeks. If you're looking at the downside, the next support available is going to be right around 143.60. If it breaks below that level, then the next support available is going to be right around 133, and it's also right around that 200-day moving average. To the buying side, buyers are going to need to get above at least 165 to regain any kind of confidence, and if it does break above that level, then it can move towards 172. Remember that AMD and Nvidia and many other semiconductor companies are still expected to report their earnings within the next couple weeks, which could be a major catalyst to these companies to move them back higher or to move them sharply lower. The next stock on our watch list is going to be Nvidia. Like AMD, Nvidia suffered last week, and you can see that it posted one of its worst days in a very long time. If you are looking at Nvidia on the daily chart, now it is below the 10, 20, and 50-day moving averages. You can see that on Thursday, it tried its best to fight off that 50-day moving average, but by Friday, buyers just couldn't do it anymore, and they sold it off for the entire day. Now, with that being said, should we give up on Nvidia? Absolutely not. This is a stock that we believe will turn back around. This downside move is temporary. Unlike all of the other semiconductor companies, Nvidia is one of the companies that is growing at an insanely rapid pace, and we can actually justify this big price to earnings ratio of 70. Nvidia's growth in terms of revenue and in terms of net income can really justify this price to earnings ratio as long as they can upkeep this growth. You can see that they grew 125% year over year between 2022 and 2023, and according to their guidance, they're expected to continue growing at that rate, which justifies the company's current pricing. So this dip on Nvidia is actually seen as more of an opportunity than it is something of a warning sign. And so if you are looking at Nvidia, don't worry so much about playing the downside. You should probably have some support points in which you add to the stock instead of selling or betting against the stock. With that being said, if you are looking at some supports, Nvidia has a gap fill down to around 676 to 696. that would be a major point to add into a position if you are looking to buy the stock. Now, buyers aren't going to feel fully comfortable again until it's back above 851, but there's a good chance that this stock will see a massive reversal on some kind of positive catalyst in the coming weeks. The next stock on our watch list is going to be Meta. Meta is reporting earnings this week. However, that is not the major news that's going to be moving them on Monday. The major thing that's going to be moving them on Monday is the Congress move to actually ban TikTok unless the company is sold to a United States company. And so this is huge news for Meta. Obviously, they're very big competitors between Reels and TikTok. And with that being said, here are some levels to focus on for Meta. Meta has been one of the stocks that actually has held very strongly in comparison to other stocks, but it did start to crack on Friday. And so that is something to keep in mind. Now, the news about TikTok may drive them up on Monday, but the way that they close out the week is going to be dependent on their earnings. You can see that analysts are extremely bullish on Meta, but they are not as bullish as they were last quarter. Meta did manage to beat earnings expectations over the last 4 quarters, and we expect them to do the same this quarter, and that'll likely drive their stock higher. So if you are looking at the bullish side for Meta, we need it back above 512.50 in order for it to move towards its all-time highs of 530. Now, last but not least, the final company on our watch list is going to be Amazon, which broke below its 50-day moving average following the lead of SPY. And you can see how much SPY has an impact on the rest of the market. The moment it broke below, everything followed. Now, Amazon, if you are looking at it on the shorter term time frame, looks something like this. You can see that it broke below this uptrend support, and now it is heading towards its 170, 175. Like Nvidia and other stocks, Amazon does have a gap to fill to around 168, but we believe that if it breaks below 170, 175, it's actually going to head closer to 165 before bouncing. To the upside, Amazon is going to need to get above 182.40 and 184.85 in order for it to regain any bullish confidence and move back towards its all-time highs. Alrighty, guys. So I hope you guys found this video helpful. Thank you so much for checking in. Don't forget to subscribe and like.